Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Last video I have started the new topic, chapter 3, that is capital budgeting. So I have already explained you the meaning of capital budgeting and what are the characteristics of capital budgeting decisions and what are the techniques available for evaluating a capital budgeting proposal. So broadly we have two methods, two techniques called traditional technique and modern technique. The traditional techniques are undiscounted techniques, payback period method and average rate of return, PBP and AR. The modern techniques are called discounted techniques where we have NPV, net present value, profitability index, PI, and internal rate of return, IRR. So in the last video, two methods I have completely explained along with advantages and disadvantages. The payback period, the time required to get back our investment, right? That is payback period. And how to calculate payback period, how to take the decision under payback period, advantage, disadvantage, already I have explained. Then average rate of return or accounting rate of return, ARR. How to calculate, how to take the decision, advantage, disadvantage. This much I have explained in the last video. In this video, this is the last video, theory video. Then after this, we'll start the problems on capital budgeting. So in this video, the remaining techniques I am going to explain. That is NPV, net present value, PI and IR. These three techniques I am going to explain. In examination, you may get a theory question or you may get a problem. So before starting the problem, my suggestion, be thorough about the concept. So watch these theory videos completely 2-3 times. Then easily you can understand the problems. So if you have not watched the theory video, I suggest you go to the playlist of my channel, select the subject Financial Management for BBA. Select the topic Capital Budgeting Theory 1. Be perfect. Then you can continue this. So before going for explanation, take the screenshot of the points which I have written on the board, then I'll explain. The first discounted technique is net present value, NPV. This is the most widely used technique for evaluating capital budgeting proposal. So compared to the previous methods, PBP and ARR, this method is more practical. It is widely used because it will overcome the disadvantages of PBP and ARR. So what is this net present value? The NPV is computed by subtracting the present value of cash outflow from the present value of cash inflows. The present value of cash outflow means the initial investment. How much amount we are going to spend on capital expenditure, that is initial investment. That is called PV of cash outflow and that will be given in the problem. But present value of cash inflows, this will not be given. We have to calculate the present values. For example, a machine requires 5 lakh rupees investment. That is the PV of cash outflow. After spending 5 lakh rupees, we are expecting annual cash inflow. First year, second year, third year, fourth year, fifth year. But these cash inflows we are going to get in the future. But we have to bring down the value to its present value, PV. So we need present value of cash inflows of all the 5 years that we have to calculate at a particular discount rate. So PV of cash inflow minus PV of cash outflow, you will get net present value. Now it involves determining the present value of all cash inflows and outflows over the project lifespan by discounting them annually. So how to get NPV? By discounting all the values, cash inflows in future. We calculate the present value at a particular discount rate. Actually, discount rate is the cost of capital or predetermined rate. That means at what rate the company has to pay to the supplier of funds. Now, using the firm's cost of capital or a predetermined rate. So easily we can calculate PV of cash inflow minus PV of cash outflow is equal to NPV. Now, criteria for selection of project. On the basis of NPV, how to take the decision whether the project should be selected or not. NPV greater than 0. That means if the NPV is positive, greater than 0, accept the project. If the NPV is less than 0 means negative. If you are getting negative NPV, reject the project. So positive values accept, negative values reject the project. That is the criteria for taking decision. Now in case of mutually exclusive projects, suppose if we are having 2 or more than 2 projects, any one of the project we have to select, that is called mutually exclusive project. In mutually exclusive project, we calculate NPV and rank them. Whichever project has the highest NPV, that will be given first rank. In that way, we can be able to select the project. Now advantages. Compared to the previous undiscounted method, this method is having many advantages. The first advantage is it recognizes the time value of money. That's why we are discounting the future cash inflows to the present value. That means it is considering time value of money. Secondly, total benefits of the project will be undertaken. In case of payback period, we calculate only up to payback period. After payback period cash inflow we ignore. That is a drawback. But here in case of NPV, we consider all the cash inflows throughout the life of the project. Profitability of the project will be accurately evaluated. In case of PBP, we are not evaluating the profitability. We are simply saying how much period we require to get back our investment. But in case of NPV, we are considering the profitability. Next one is this method aligns with the objective of maximizing shareholders' wealth. Ultimate objective of financial management is to maximize the wealth of the shareholders. And this method is in alignment with the objective of the financial management. So these are few advantages. Now limitations. More complex and difficult to calculate. If you compare the PBP and NPV, PBP easily we can calculate. Not much difficulty we require. Easily we can find out the PBP. But calculating the NPV is a tedious activity. That means we have more calculations, time consuming, more complex. Then determining appropriate discount factor will be challenging. In order to calculate the present value of cash inflows, we need a discounting factor. If we take a correct discounting factor, then our conclusion will be correct. If we take a discounting factor, then our NPV decision may be wrong. So NPV decision depends on the discounting factor, how you have selected the discounting factor. Then inaccurate results when comparing projects with unequal lifespan. If we have different projects having different lifespans, for example, one project life is 8 years, another project 10 years, another project 12 years. If different lifespans are there for different projects, it will be difficult to choose by applying this NPV. Last one. It may not provide reliable results when comparing project with unequal investment amounts. If the investment amount is also different, for example, A project requires 10 lakh, B project requires 15 lakh, C project requires 18 lakh. Now you have to compare the NPV. You may get wrong results because the amount involved in the projects are different. So if the lifespan is different, if the amount is different, then NPV will not give the right decision. So it will give right decision when the lifespan is same and amount of investment is also same. In examination, you may get a theory question. What is NPV and what are the advantages and limitations of NPV? Just now I have explained. So watch the video 2-3 times. You will get the points, you can understand and you can write in examination. Now, the next method is Profitability Index. This Profitability Index is exactly similar to NPV. The only difference is, here we have taken the difference between the present value of cash inflows and present value of cash outflow. Whereas in Profitability Index, we calculate the ratio. Here difference and here ratio. Ratio means we take present value of cash inflow divided by present value of cash outflow. So that means inflow we have taken in numerator and outflow we are taking in denominator. But here we are taking the difference. That is the only difference. So profitability index formula is PV of cash inflow divided by present value of cash outflow. Decision criteria: if the PI value is greater than 1, if the profitability index is more than 1, accept the project. If the profitability value is less than 1, reject the project. Now you will get one question in your mind. If the profitability is exactly 1, what will happen? It is called indifferent situation. Indifferent situation means there is neither profit nor loss. You can accept or reject because the PV of cash inflow and PV of cash outflow both are exactly equal. That is the meaning when it is 1. Now in case of mutually exclusive, suppose if you have 2 or more than 2 projects and you have to select any one, then in that case you calculate the profitability index for all the projects and rank it. The highest PI will be given first rank. In that way we give the ranking. Then we can select first rank, second rank, third rank. Then advantages. Now advantages of PI. Suitable for evaluating project with significant differences in cost. If the cost of the project is different, then this will be suitable. If the cost of the projects are same, then NPV is better. So whatever drawback we are having in NPV, that drawback we are overcoming in profitability index. So this is suitable when the amount of the projects are not same, unequal. Time value of money is considered. There is the same advantage what we are having in NPV also. Then entire economic life is considered. Just like PBP, we are considering only up to payback period. But in NPV and PI method, we consider the entire life of the project. Then limitations. The first is more complex and difficult to calculate, just like the NPV. Calculations are more in calculating NPV as well as PI. Then determining appropriate discount rate. Calculating present value of cash inflows, we require discount rate. If you take accurate discount rate, then you get accurate decision. So decision depends on taking the correct discount rate. And inaccurate results when comparing projects with unequal lifespan. If equal lifespan is there, then NPV is better. If the lifespan is unequal, again it may give different decisions. This is regarding PI. So two methods are completed, NPV as well as PI. Now the last and final method, final technique is IRR, internal rate of return. This is little bit tedious method, time consuming method and little bit complex method. But IRR is that rate at which present value of cash inflow and present value of cash outflow both are equal. In other words, NPV will be 0 when inflow and outflow both are equal. So at what discount rate PV of cash inflow and PV of cash outflow both are equal, that discount rate is called internal rate of return. Next, decision criteria. In case of single project, calculated IRR is greater than the cutoff rate, cutoff IRR. What is this cutoff IRR? This is the rate of return which is fixed by the management by considering the cost of capital. The company has to pay dividend on equity shares, the company has to pay dividend on preference shares, the company has to pay interest on debentures, interest on bank loan. This dividend and interest is called cost of capital. So any business wants a higher return than the cost of capital. If the cost of capital is more and the return is less, why to run the business? It will incur loss. So that's why the cutoff rate is the weighted average cost of capital. That is called cutoff IRR. Suppose the actual IRR is 20%, whereas cutoff IRR is 18%. That means actual IRR is more, so accept the project. If the actual IRR is 15%, whereas cutoff rate is 20%, reject the project because IRR is giving only 15%. Whereas company's cost of capital is 20%. So reject the project. In case of mutually exclusive project, we rank the project according to IRR. We calculate the IRR of project 1, project 2, project 3. Highest IRR will be given first rank. Like this, we give the ranking and then select the project. Then determination of IRR. How to calculate IRR? Two different methods are there. One is trial and error method, second is shortcut method. In trial and error method, we arbitrarily take a single discount rate and calculate what is the PV of cash inflow and compare this PV of cash inflow with PV of cash outflow. If both are equal, you are very lucky because whatever arbitrarily rate you have taken, that is the IRR. But this will seldom happens. What will happen? The calculated PV of cash inflow will be different from the PV of cash outflow. In that case, you take another rate. Like the trial and error basis, you go on taking different rates and calculating the PV of cash inflow, comparing with PV of cash outflow to find out at which rate both are equal. It will be a time-consuming process. That's why this trial and error method will not be followed. Shortcut method will be followed. What is a shortcut? Two cases are there in shortcut method. The first case, uniform cash inflows. If the annual cash inflows are constant, first year 1 lakh, second year 1 lakh, third year 1 lakh, fourth year 1 lakh, fifth year 1 lakh. 5 years is the life of the project and every year constant cash inflow. In that case, how to calculate IRR? Calculate actual IRR. Look at two factors in PV of annuity. First one, actual PVP. If the annual cash inflows are constant, first calculate actual PVP. What is the formula for PVP? Initial investment divided by constant annual cash inflow. This already I have explained in the last video. So initial investment by constant cash inflow, you get PVP. Now in this case also calculate PVP. Suppose we got PVP 4.5. 4.5 is the PVP. Then second step, next step is go to the PV of annuity table. Present value annuity table. In that table against the life of the project. Suppose the project life is 5 years. So in the line 5 years, locate 4.5. What is 4.5? PVP. Actual PVP. Locate 4.5. Exactly 4.5 if you get, you are the luckiest person on the earth. Because directly you got the IRR. See where 4.5 is. 4.5 is against 16%. In the column 16%. So 16% is the IRR. But this will not happen. Exactly 4.5 you will not get. You may get either less than 4.5 or more than 4.5. So locate two factors. At 16% it is 4.2. At 18%, 16% it is 4.2. 14% it is 4.6. So one factor should be more than 4.5. Another factor should be less than 4.5. Now look at what discount rate. One factor less than 4.5, another factor more than 4.5. Two factors you have at two different rates. Now you apply the formula. IRR is equal to RL plus DFRL minus PB divided by DFRL minus DFRH into delta R. What is RL? Lower rate. Two rates you got in annuity table. One lower rate, one higher rate. Lower rate is RL. PB stands for payback period. First step what you have calculated. 4.5. Example. Then DFRL, discount factor at lower rate. And DFRH, discount factor at higher rate. And delta R, difference between the two rates. That's all. We get the IRR by substituting these values in the formula. This method we apply only if the annual cash inflows are constant. If the annual cash inflows are not constant, for example, first year 2 lakh, second year 1,50,000, third year 3 lakh, then fourth year 3,50,000, fifth year 5 lakh. Every year different cash inflows are there. In that we calculate fake PVP, imaginary PVP. The formula is initial investment divided by average cash inflow, not constant. Here constant, actual PVP when we calculate, constant cash inflow. But here denominator, average cash inflow. So imaginary PVP will get. Refer the PV of annuity table against the life of the project nearest to fake PVP. You are having one fake PVP. Now go to the PV of annuity table along the line of the life of the project. The life of the project is 5 years. In the line 5 years, locate that factor, fake PVP factor. Suppose the fake PV factor is 4.5. You won't get exact 4.5. Nearest to 4.5, what is the factor? At what rate? Select that rate and calculate the PV of cash inflow. Now compare this PV of cash inflow with PV of cash outflow. It may be different. Suppose the actual PV of cash inflow is more than the initial investment. Now in order to reduce the PV of cash inflow, we increase the rate. Another rate we take. Then again you calculate PV of cash inflow. So one PV of cash inflow should be more than initial investment and the other PV of cash inflow should be less than initial investment. In between these two rates is our IRR. So here IRR, the formula is RL plus PVCIL minus II divided by PVCIL minus PVCIH into delta R. RL stands for lower rate. Two rates you got, lower rate, higher rate. So we'll take the lower rate. II stands for initial investment, PV of cash outflow, that will be given in the problem. And PVCIL, present value of cash inflow at lower rate. Then PVCIH, present value of cash inflow at higher rate. And delta R, difference between the two rates. This formula will give you the IRR of the project. The concept will be more clear while doing the problems on IRR. Now I'll explain the advantages and disadvantages of internal rate of return. How to compute IRR, already I explained you, through different methods are there. Now advantages. First advantage of IRR is time value of money is considered. In all the discounted techniques, whether it is NPV, PI and IRR, all the three methods we are considering the time value of money. Whereas in the earlier method, undiscounted method like PBP and ARR, time value of money is not considered. So here it is an advantage. Secondly, it considers the profitability of the project or the entire economic life of the project. In PBP, we are not considering the benefit, the profitability of the entire life. But in IRR, we consider the profitability for the entire economic life of the project. Next one, it's superior to NPV as it does not require a discounting rate. For calculating NPV, we need a discount rate, and that discount rate is the cutoff rate or predetermined rate or cost of capital. And if you wrongly select a discount rate, then decision given by NPV may be wrong. So NPV decision depends on discounting rate. That is in NPV. But IRR does not require any discount rate. But IRR itself will give the rate of return of the project. Next is it leads to realization of the objective of financial management. Because we are considering the highest IRR, whichever project gives more IRR, that means the returns are more. When returns are more, the business can be able to achieve the objectives. The objective of financial management is to maximize the wealth of the shareholders. So this method is in compatibility with the objective of financial management. So these are few advantages. But disadvantages of IRR is difficult to understand and tedious calculations. That means in order to understand IRR, we need some expert knowledge, expert command. Then only we can be able to understand IRR. And calculations are more compared to NPV and PI, more calculations are required in IRR. Next, the results of NPV and IRR may differ at times when projects differ in size, life and timing of cash flows. Same project, if we take a decision under NPV and IRR, both the decision may be conflicting, opposite decision. Example, NPV says the project should be accepted, whereas IRR may say the project should be rejected. This may happen. When it will happen? When the life of the project may be different, or when the life of the project is different, or the amount of investment required may be different, and the timing of cash flows may be different. On account of all these things, the results given by NPV and IRR may be different, may be conflicting. That is the disadvantage. So four advantages and two disadvantages. Apart from that, many more are there. But if you remember these two, that will be enough. This is the end of all the techniques of evaluating capital budgeting proposals. Now, drawbacks, limitations of capital budgeting decisions. Actually, capital budgeting is very important technique for evaluating capital projects. So before making investment in any project, long-term financial project, we have to analyze it. We have to evaluate it. So many techniques will apply: PBP, ARR, NPV, PI, IRR. But do you think that if we apply this technique, we are 100% sure that we will achieve our objective? No. Many times the capital budgeting decisions may be wrong. So what are the limitations of these capital budgeting techniques? The first is forecasting future cash flows. So whenever we want to invest in a capital project, initial investment is now, but cash inflows will occur in future. And future is completely uncertain. There is no machinery, there is no technique, no formula in the whole world where we can predict the future. We only estimate the future cash inflows. If our estimates are wrong, then definitely decisions may also go wrong. So ultimately it depends how accurately you are forecasting the cash flows. Secondly, the complexity of the investment project. The projects are very much complicated. A huge project is there which require a number of costs. It is difficult to ascertain the actual cost of the project because the project is very complex project, very complicated project. That makes the capital budgeting decision difficult. Next is non-financial benefits. We will see only financial benefits. That means when we evaluate capital budgeting decision, we consider only financial aspects, ignoring the non-financial aspects. But for a business, a company, a business organization has to consider both financial and non-financial factors in evaluating the benefits. Next one is risk assessment. Future is uncertain, but that uncertainty can be incorporated by undertaking the risk. So there are risk adjusted technique of evaluating capital budgeting proposals. So we should not ignore the risk, we should incorporate the risk in evaluating capital budgeting proposals. Next one, assuming constant discount rate. When we discount the future cash inflows to present cash inflow, we use the discount rate, but we take a constant discount rate. But do you think that the discount rate will remain same for all the future years? No. For example, the cutoff rate, the cost of capital presently is 20%. And at the 20% we are evaluating all the proposals. But do you think that cost of capital will remain same 20% in the second year, third year, fourth year, fifth year? No, it may change. So that is also a hurdle. That's also a disadvantage. Last one is this one, political and regulatory risk. Business is a part of the society. So it works within the regulatory framework. So there are possibilities in future, there are political changes, regulatory law will change. So due to all these regulatory changes and political changes, it will have an impact on the capital budgeting decision. So these are few disadvantages of capital budgeting decisions. That's all. So I have completed the theoretical part of this topic, capital budgeting. If you watch the video 2-3 times, both the videos, then definitely you will get the complete command over this topic of capital budgeting, and easily you can understand and solve the problems on capital budgeting. So if you are satisfied with my video, like it, share it among your friends and groups so that more students can watch the video, and subscribe my channel if you have not yet subscribed. Inshallah, we'll continue the problems. We'll start the problems in the next video.